This is the best piece of advice I've ever heard about investing. It came from a millionaire I looked up to as a kid. After overhearing him talk about investing, I wanted to get involved. But as a complete beginner, I didn't know where to start. So I asked him, how do I pick the right stocks to invest in? His answer was very simple. Treat it like finding a girlfriend. This is quite a clever way to look at it, because when you buy a share in a company, you actually become a part owner. This is like a partnership between you and the company. And just like a relationship, you want to make sure it's happy, long, and successful. But look, I'm not going to pretend that there's a crystal ball that can tell you when to buy a stock before it rockets in value like most of the fake gurus online. However, there are certainly a few things you can do to tip the odds in your favour. When you're looking for a partner, you need to have a strategy in mind. Are you going to shower them with gifts like a simp, or treat them mean to keep them keen? You'll get very different results depending on which strategy you choose, and the same goes for stocks. So just like dating, you need to figure out how you're going to approach the stock market so that you get the results you want. There are two strategies you can choose from, the technical or the fundamental approach. Both of these options are very different, so let's quickly go over what they involve. Technical analysis is mainly for short-term day traders. They use charts and price action to identify patterns that supposedly help them predict if a stock is going to go up or down in the short term. I use the word supposedly because, in my opinion, most of the people using this strategy are glorified gamblers. Is it possible to day trade successfully? Yes, but more than 95% of day traders lose money rather than making it, according to the Motley Fool. Fundamental analysis is like being a detective for a company. You look at everything, from their financial reports to how well known the brand is and who's running the show. All these pieces of information help you understand how the company is doing now and how it might perform in the future. This approach can help you pick a range of stocks that can make you a nice amount of money over a 3 to 10 year period. I know saying this will probably ruin my watch time, but I only want people getting into this for the right reasons. So if you're looking for a way to get rich quick, then stop watching my video now. My goal is to secure your financial future, not just help you make a quick buck. Also remember, with any kind of investing, your money can go down as well as up. If you're still with me, then comment down below, I'm in, so I know how many of you are willing to invest for the long term. Right, all done? Cool, let's jump into. When you're on a dating app and checking out someone's profile, you usually look at their pictures and read their bio to see if they'd make a good match. It's exactly the same when you're thinking about investing in a company. You have to check out the company's profile, which in this case is something called a balance sheet. A balance sheet is a financial statement that provides a snapshot of a company's financial position at a specific point in time. It details the company's assets, liabilities, and shareholders' equity. Don't worry if that sounds a bit confusing. We'll take a look at one together and I'll break it down with you. I'm going to be using Trading 212 to do this, which is a great place to research and buy stocks. You're welcome to download it and follow along. Trading 212 is also sponsoring this portion of the video, and if you use the code Tilbury, you'll also get a free fractional share worth up to £100 when you open your account. I'll put the link in the description. Plus, you can get more free stocks by inviting your friends. Both of you will get a free share as long as they fund their account. I'm going to be using their desktop website for this video, but you can do all of this on the mobile app if you want to. For everyone in the USA, you can find the same information on Yahoo Finance. Remember that nothing in this video should be taken as financial advice. I'm not a financial advisor, and when investing, your capital is at risk. So to find the balance sheet, just head to the stock you're interested in. For this example, I'm going to pick Coca-Cola. Scroll down the page, click on the financials and then the balance sheet and more financials. This pulls up a pretty complicated looking page, but trust me, it is actually very simple. To help you understand this balance sheet, think of it like a cookie jar. There you go. At the top, you've got the current assets. These are like the cookies you can grab and eat. Very nice. For a company, this is the cash, or anything that can be turned into cash within 12 months. Next, you have the longer term assets. These are like the cookies that are deeper down in the jar. For a company, this often includes the headquarters and equipment. Here you have the intangible assets. These are like the invisible things that make the cookies taste good. You can't touch these things, but they bring a lot of value. For a company, this is patents, intellectual property, trademarks, and goodwill. This next section is all about liabilities. These are like the cookies that you've promised to your friends for borrowing their ingredients. I'm most interested in the current liabilities, as these will need to be paid back within 1 year or a normal operating cycle. So now you know what all of this information means. What should you actually do with it? Well, there's a simple calculation you can do to easily know if a company is high risk or not, and that is total current assets divided by total current liabilities. A good rule of thumb is this number should be above 1. But how does this actually work in practice? Well, let's put Coca-Cola's numbers in. Their total current assets are $26.73 billion. So if we divide that by their total current liabilities, which are $23.57 billion, that comes to approximately 1.13. This means the company has $1.3 in current assets for every $1 in current liabilities, indicating they have enough short-term assets to cover their short-term debts. This is a great indicator, but our work is far from over. When you're getting to know someone new, you're probably curious about their past relationships. It's like doing a bit of a background check, right? You might wonder whether they've ever cheated or how many partners they've had. It's pretty much the same when you're considering investing. Before you put your hard-earned cash into a company, you want to check out its track record. That's where the income statement comes in. And unlike people, public companies have to be upfront and honest about their past. An income statement is like a report card for a company, showing how well it did over a specific period, like a month, a quarter, or a year. Put simply, it tells you how much money the company made and how much it spent. This is normally found in the same place as the balance sheet. If you're using the Trading 212 app like me, then just click on the first tab and then you'll see all the information. Here at the top we have the total revenue, which is the total the business took in the time period. As we can see from Coca-Cola, they took $45.75 billion in 2023, which isn't too shabby. If we scroll down a bit, we get to the net income, which is the money the company makes after all expenses have been deducted. For Coca-Cola, this is $10.71 billion. So why does this matter? Well, every business has two main types of expenses: the cost of revenue and the cost of operations. If either of these are too high, then it could be a red flag. Just think about it. If you were selling custom t-shirts, you'd have to spend money on fabric and printing. This is your cost of revenue, as you can't create custom t-shirts without these materials, so this is a necessary expense. But that's not it. You'd also have to spend money on marketing and potentially staff. These are known as your operating expenses. Once you subtract both the cost of revenue and the operating expenses from the total money you make from selling your custom t-shirts, you get your operating income. Now, if you just scale up that example, it's the same idea for big companies like Coca-Cola. See here, this is the operating income. So now you know what all this information means. What should you actually do with it? Well, here's a simple calculation to see if a business is making a healthy amount of profit. Operating income divided by total revenue times 100. According to Tide Banking, as a rule of thumb, 5% is a low profit margin, 10% is a healthy margin, and 20% is a high margin. If we plug Coca-Cola's numbers into this calculation, we get approximately 25.73%, which is a high profit margin. This is a great indicator to use. However, it's important to remember that older, more established companies will be more profitable than newer, faster growing companies. So profitability isn't the most important thing. I mean, Amazon took years to make a profit and look at them now. But saying this, you should also keep in mind that a company that's done well in the past doesn't mean that it will continue to do well in the future. Past performance doesn't guarantee future results. Listen, it might not sound like a romantic thing to say, but if you're thinking of getting involved with someone, you don't want them to be bad with money. It can lead to a whole lot of headaches down the line, trust me. In fact, money issues are a huge reason why relationships break up. The same goes for companies. You don't want to invest your money in a company that can't handle it correctly. That's why you need to check out their cash flow statement. Cash flow statement shows how much money is coming in and going out of a company over a period of time. It's divided into 3 parts: operating activities, investing activities, and financing activities. They sound confusing, but trust me, they are super simple. Let's run through them one by one and I'll let you know what to look out for. Operating activities show the money a company makes from its regular business operations. In Coca-Cola's case, that's selling their various beverages. All you need to look for here is a positive number, like this. It means the company is making more money than it spends on its day-to-day operations. This is a good sign. Investing activity shows the money the company spends on investments like buying new equipment, buildings, or other companies. It also includes money made from selling those kinds of investments. Believe it or not, this negative number here isn't a bad thing. This is because the company is reinvesting back into the business. I always like it when I see that a company is investing wisely in their future. Just be cautious that they're not spending too much or selling off lots of assets. Financing activities is about the money a company borrows or gets from selling pieces of the company, and the money it uses to pay back loans or give rewards to stock owners in the form of dividends. It's very important for you to keep an eye on how they're managing their debt and dividend payments. Be cautious if they rely too much on borrowing and if they're paying high dividends with a negative cash flow. It's like if you won a chunk of money and stopped working and then kept giving all your friends expensive gifts. It's just not sustainable, and eventually you'll run out of cash. However, this isn't the case with Coca-Cola, because even though they gave away $7.95 billion worth of dividends to their shareholders, it's safe to say with that kind of positive cash flow, they can afford it. Have you ever been really attracted to someone online who seems perfect on paper, but when you finally meet them, you don't feel that spark? This could be similar to stocks. A company may appear to be a good investment based on data, but there are factors that spreadsheets just can't capture. That's why you need to cross-examine with something called qualitative analysis. This basically means checking out things that aren't numerical, like how well known the company is, how loyal their customers are, and how happy those customers are with that company. So yeah, it's not all about the numbers. You need to seek out this information from sources that aren't as easy to find and really embody your inner Sherlock Holmes. So what information should you be looking for? And how can you find it when it's not immediately obvious? Well, there are 3 key things you need to keep an eye on. The first thing is brand recognition. If you went to a bunch of people in the street and said, "Tell me what you think about Apple," you'd probably get mostly positive responses about their product quality and good privacy reputation. I mean, most people out there own an Apple device and they've built a very strong customer base. But what if I asked you about a brand that wasn't as popular like Xiaomi? You'd probably get a lot more blank stares, especially in the UK. If you haven't heard of it, it's a Chinese tech company. So just through those 2 examples, there is a clear contrast between the two, and I'd say 99.9% of you would rather invest in Apple stock just based off its brand recognition, even though Xiaomi is a major player in China and emerging markets with a growing customer base. But why is this? Well, companies with a strong brand recognition have built up a lot of trust with their customers, meaning that they're less impacted by any competition, therefore minimizing your risk as an investor. It's like the king on a chessboard. Every move revolves around it, and its position is central to the game, making it irreplaceable. The second key thing to check out is the company's leadership. You can find all this information by researching the company's board of directors, reading transcripts of earnings calls, and checking out the executives' LinkedIn profiles. However, it's not only important to know who these leaders are, but how long they've been working there. In general, The longer they've been in charge, the more knowledgeable they are, meaning the more successful they're likely to be. In addition to this, lots of CEOs have big followings now on Twitter. However, this comes with both pros and cons. With the power to influence millions with just a tweet, it can send stock prices to the moon or crashing back down. I mean, back in 2016, Donald Trump tweeted the F-35 program and cost is out of control. Billions of dollars can and will be saved on military and other purchases after January the 20th. That F-35 program was a Lockheed Martin project. After that tweet, Lockheed Martin's stock price took a nosedive. The company's shares fell by 2.5% on the same day, wiping out nearly $4 billion in market value. So it's becoming more important than ever to invest in companies with a sensible CEO. Otherwise, the wrong tweet could lead to a very bumpy ride. The third important thing to research is any competitive advantages. So this can be things like patents, loyal customer bases, or disruptive business models. These advantages set them apart from the competition, helping them make more money and grow their businesses faster over time. For example, Tesla has managed to secure a competitive advantage through cutting-edge electric vehicle technology and an expansive charging network. These competitive advantages are like gold for investors because it means lower risk and bigger potential rewards. You'll be able to find all this information on the company's website and also through a good old Google search. It's time consuming, yes, but understanding these aspects could make or break your investment. Remember, research is your best friend. It's better to spend a couple of weeks researching rather than make a rushed investment and have it backfire. Let's say you hear a nasty rumor about the person you're seeing. You might panic and dump them without getting to the truth. This is what so many people do when they hear bad news about the company they've invested in. They rush to sell it without actually giving it any proper thought. They just act on emotion. The news is actually so powerful. Think back to when the news broke that we might see empty shelves in the supermarkets. What did everyone do? They panic bought toilet rolls until they really did run out. The panic buying just made the situation so much worse. Just imagine if that wasn't reported on the news. There wouldn't have been panic buying and toilet rolls wouldn't have sold out in every store. The news has the same power over investors too and can cause abrupt surges in stock prices, but more often than not, it causes extreme panic selling. One example of panic selling is when the Cambridge Analytica scandal broke in March 2018 and personal data was unethically taken, causing Facebook stock to plummet nearly 18% in just 10 days as investors reacted to the news of data misuse. But as we can see, if we zoom out, since then the stock has gone up by more than 200%. This was just a blip on the radar, and long-term investors that understood that held strong because they were confident in their research. So if the news is full of fear-mongering, then how do you know when to actually sell a stock? Well, there's a few occasions when you should sell a stock, and this might not be what you're expecting to hear. But these occasions actually depend on you and not the stock market. For example, if you find yourself in a financial emergency and don't have any emergency fund to fall back on, then I'd advise you sell your shares to get yourself out of that sticky situation. Or on a more positive note, maybe you've hit a financial goal and you'd like to take a vacation. I wouldn't normally suggest this to people, but if it's a figure at which you would feel satisfied selling the stock at, then do it and enjoy your gains. The last reason to sell a stock is when you no longer believe in the fundamentals of the company and their future trajectory. In this case, it may be time to cut and run. When looking for a partner, you don't want to settle with the first person you date. It's important to explore what different people have to offer. Some may seem perfect but are too self-absorbed, while others may have a great potential. The same concept applies when building your investment portfolio. The main types of stocks are value and growth. It's beneficial to understand both, so you can decide whether to focus on just one type or mix and match. Value stocks are normally shares in big, well-known companies. These companies have a few key features. First, their stock prices are considered lower compared to other companies in the market. They also have a low price to earnings ratio, which means they make good money compared to their stock price. Additionally, they're stable and they don't have wild ups and downs in their stock prices, and they pay dividends, which essentially means they regularly give some of their profits back to their investors. Value stocks are often found in companies that people rely on, even when times are tough, like during a recession, for example. These companies make or provide things that people need no matter what. Examples include consumer staples, which are everyday products like food and household items, energy companies that provide fuel and power, financials like banks, and industrials that build things and provide raw materials. Some well-known examples of value stocks are Berkshire Hathaway, which is owned by Warren Buffett and invests in many different companies. Procter & Gamble, which makes everyday products like shampoo and toothpaste, and JP Morgan, a major bank. Growth stocks, on the other hand, are usually seen as overvalued compared to the market. They tend to be pretty volatile, meaning their stock prices can go up and down a lot. These stocks have higher price to earnings ratios. This means that investors expect them to grow a lot in the future, and they pay little to no dividends. Some growth stocks aren't even profitable for a long time, as they reinvest their earnings to fuel further growth. Growth stocks are expected to grow at a more rapid pace than the overall market, which is why they often outperform the market. Some well-known examples of growth stocks include Amazon, Meta Platforms, Nvidia, and Tesla. If you're not sure if the stock is growth or value, then a quick way to tell is by using the PE ratio. You can easily find this here on Trading 212. Typically, the average PE ratio is around 20 to 25. Anything below that would be considered good, whereas anything above would be worse. However, this is just a general rule of thumb and does vary depending on the industry, so make sure to compare it with some other companies in that sector. Once you've determined whether you're a value, growth, or mixed investor, you need to ensure you have a diverse range of stocks in your portfolio. This is what we call diversification. So if one of your stocks takes a dive, you're banking on the others to balance things out. A general rule is not to have more than 5% of your money in one stock and no more than 20% of your investments in one sector, such as technology, for example. It's a good idea to have stocks in at least 5 different sectors, a minimum of 2 countries, and more than 25 different stocks in total. You could also look into having a cash ISA too, which is basically just an individual savings in the UK which allows you to save money and earn tax-free interest. At the moment, Trading 212 seem to have one of the highest paying cash ISAs right now at 5.2%. So if you've already used the code Tilbury or the link in the description to pick up your free fractional share worth up to £100, then all you have to do is go up here and they'll walk you through the process. If after watching this video you think picking individual stocks seems too time consuming, then there is a way you can cut out pretty much all the research and, in a lot of cases, get even better results. If you want to understand how I make around $17,000 a week using index fund investing, then you should watch this next video where I explain everything in detail. But don't click on it just yet. Make sure to subscribe if you want to grow your wealth, okay? I'll see you over there.